Right now, while you're watching this, a bank somewhere just created money. Not printed it, not borrowed it from the government. Created it out of nothing. And it's completely legal. You've been told your whole life that money has to come from somewhere, that it's earned, printed by central banks, or backed by something real. That's not how it works, not even close. The money in your bank account right now, most of it never existed until someone asked for a loan. This isn't a conspiracy, it's just how the system operates. And once you understand it, you'll never look at your savings the same way again. Let's start with something simple. You deposit $1,000 in your bank. You can still spend that $1,000 whenever you want, it's yours. But here's the thing, the bank doesn't keep your $1,000 sitting in a vault with your name on it. They lend it out to someone else, who then spends it. And that person's spending becomes someone else's deposit, which the bank lends out again. $1,000 just became $2,000, then $3,000, then more. And nobody printed anything. This is called fractional reserve banking. Banks only keep a fraction of deposits as reserves. The rest gets loaned out over and over. It's a multiplication machine, and it's been running for centuries. But here's where it gets weird. That process I just described, that's not even the main way banks create money anymore. Most people think banks lend out deposits. That's the story we've been told. Deposits come in, loans go out. Simple. Except that's backwards. Banks create loans first, then deposits appear. When you walk into a bank and get approved for a $50,000 car loan, the bank doesn't check if they have $50,000 in deposits sitting around. They just type $50,000 into your account. New money, created the moment they approve the loan. You didn't borrow someone else's savings. You borrowed money that didn't exist 5 minutes ago. The Bank of England admitted this publicly in 2014. Their exact words. Rather than banks receiving deposits when households save and then lending them out, bank lending creates deposits. Read that again. Loans create deposits, not the other way around. So where does the money actually come from? It comes from your promise to pay it back. That's it. Your signature on a loan agreement becomes an asset for the bank, and that asset allows them to create new money. Your debt is their permission slip. Every time someone takes out a mortgage, a business line of credit, a student loan, new money enters the economy. Money that wasn't there before. And the only thing backing it is the belief that you'll pay it back with interest. Now you're probably thinking, wait, if banks can just create money, why do they need my deposits at all? Good question. Deposits do two things. First, they give the bank credibility. A bank with $1 billion in deposits looks stable, trustworthy. People feel safe putting their money there, which allows the bank to create even more loans. Second, deposits are cheap. Banks pay you maybe 0.5% interest on your savings. Then they lend that money out at 5, 7, 10%. The spread is profit, pure profit. But they don't need your deposit to make the loan. They need your deposit to make the whole system look legitimate. Let's talk numbers. In the United States, the reserve requirement for most banks was dropped to 0 in March 2020. 0. That means banks are not required to hold any reserves against deposits. Technically, they could lend out infinite money. The only limit is demand for loans and the bank's own risk assessment. Before 2020, the requirement was 10%. So for every $100 in deposits, banks could create up to $900 in new loans, a 10-to-1 multiplication. Now, there's no official floor. The global money supply has exploded because of this. In 2000, the total broad money supply in the US was about $5 trillion. By 2020, it was over $20 trillion. Today, it's even higher. Most of that money was never printed. It was created by banks issuing loans. You've probably heard the phrase printing money thrown around when people talk about inflation or government spending, but the government only prints a tiny fraction of the total money supply. The real money printers are banks, and they've been running non-stop. Here's the uncomfortable part. This system only works if people keep borrowing and paying back. If everyone tried to withdraw their deposits at once, the system collapses, because the money isn't really there. It's been lent out multiple times over. This is called a bank run, and it's happened before. In 2008, banks stopped trusting each other, lending froze, and the whole system seized up. Governments had to step in with trillions in bailouts just to keep the gears turning, because if the banks go down, the money disappears. All of it. Not just the bank's money, your money. But let's rewind. How did we get here? Fractional reserve banking didn't start with some grand economic theory. It started with goldsmiths. Centuries ago, people stored their gold with goldsmiths for safekeeping. In return, they got a receipt. That receipt could be traded like money because everyone knew it was backed by real gold sitting in a vault. But the goldsmiths noticed something. Most people never came back for their gold. The gold just sat there. So the goldsmiths started issuing more receipts than they had gold. They'd lend out receipts, charge interest, and as long as not everyone showed up at once, no one noticed. This was the birth of fractional reserve banking, a system built on the assumption that not everyone will ask for their money at the same time. It worked for a while, until it didn't. Fast forward to today. The receipts are digital, the gold is gone, and the system runs on trust. Trust that your bank will be there tomorrow. Trust that the money in your account is real. Trust that the whole thing won't collapse. And most of the time, that trust holds. But every so often, it breaks. In March 2023, Silicon Valley Bank collapsed in under 48 hours. Customers tried to withdraw their money. The bank didn't have it. $16 billion vanished in a single day. The FDIC stepped in. Depositors were made whole, but only because the government intervened. Your deposits are insured up to $250,000 by the FDIC, which sounds reassuring until you realize the FDIC's total insurance fund is around $120 billion, and total deposits in the US banking system are over $18 trillion. If multiple large banks failed at once, that fund wouldn't even cover a single percentage point. The system works because we believe it works. The moment that belief cracks, the money evaporates. Now let's talk about what this means for you. When banks create money through loans, that money enters the economy. It gets spent, it circulates, it bids up prices. More money chasing the same amount of goods equals inflation. This is why central banks raise interest rates when inflation gets too high. Higher rates make borrowing more expensive. People take out fewer loans. Less new money gets created. The money supply growth slows. Prices stabilize. But here's the trap. Our entire economy is built on growth, and growth requires more money. If banks stop lending, the economy contracts, businesses fail, unemployment rises, defaults increase, which makes banks even more cautious about lending, which contracts the economy further. It's a feedback loop, and it goes both ways. Too much lending creates inflation and bubbles. Too little creates recession and collapse. Central banks spend their entire existence trying to walk this tightrope, and they don't always succeed. The 2008 financial crisis happened because banks created too much money through bad loans, subprime mortgages, loans to people who couldn't pay them back. When defaults spiked, the whole system locked up. The 1930s Great Depression happened because banks didn't create enough money. Credit dried up. Businesses couldn't borrow, the economy collapsed, and it took a world war to restart growth. We're always one extreme or the other. never balanced. So why don't governments just create the money themselves? Why let private banks do it? Good question. Some economists argue exactly that. They say money creation should be a public utility, that governments should issue debt-free money directly into the economy. No loans, no interest, just new money for infrastructure, healthcare, education. It's called sovereign money, or public money creation, and it's been proposed many times, but it never happens, because banks are powerful and they profit enormously from the current system. Every loan they create generates interest income for decades. A single mortgage can generate hundreds of thousands in interest payments over 30 years. Globally, banks make trillions in profit from this system. They're not going to give that up. And governments benefit too. They can borrow newly created money from banks to fund deficits without directly printing cash. It's politically easier, less visible. The inflation happens slowly, quietly. Everyone in power benefits from keeping the system as is, except you. You're the one paying interest on money that didn't exist before you borrowed it. You're the one watching your savings lose value to inflation caused by endless money creation. You're the one taking the risk when the system wobbles, and it will wobble again. It always does. Here's the final piece. Money today isn't backed by gold or silver or anything tangible. It's backed by debt. Your debt, my debt, government debt, corporate debt. The money supply is essentially a ledger of all outstanding loans. When those loans get paid off, the money disappears. It goes back to nothing. This is why total debt keeps growing. If we paid off all debt, there'd be no money left. The system would collapse. We're locked in, forever borrowing, forever creating, forever inflating. Some people call this a Ponzi scheme. That's not quite accurate. A Ponzi scheme requires new investors to pay old ones. This system requires new borrowers to keep the whole thing alive. It's not fraud, it's just fragile. And here's what almost no one talks about. If banks create money when they lend, and that money disappears when loans are repaid, where does the interest come from? Think about it. You borrow $100,000. The bank creates that $100,000 out of nothing, but you owe back $150,000 over the life of the loan. Where does that extra $50,000 come from? It has to come from someone else's loan, someone else's newly created money. The system requires perpetual growth in lending just to cover the interest on existing loans. If lending ever stops growing, defaults spike, banks fail, money vanishes. We're on a treadmill, and the speed keeps increasing. So what happens next? No one knows. We've been running this experiment for about 50 years in its current form, since Nixon ended the gold standard in 1971. Before that, money was at least theoretically tied to something real. Now it's pure abstraction, numbers in a database, created by keystrokes, destroyed by defaults. Some economists think we can keep this going forever, as long as productivity grows, as long as people keep working, keep borrowing, keep trusting. Others think we're headed for a reckoning, that debt levels are unsustainable, that the money supply has grown too large, that inflation will spiral or the system will seize up again. Both groups have models, data, arguments. Neither group knows for sure, because we've never done this before, not at this scale, not with this much debt, not with money that's entirely untethered from anything physical. We're flying blind, and the people flying the plane are the same ones who profit from keeping it in the air. So here's what you're left with. The money in your account is real in the sense that you can spend it, but it's not real in the sense that it exists physically or is backed by anything tangible. It's a shared hallucination, a collective agreement, and as long as everyone keeps agreeing, it works. The moment that agreement breaks, your savings, your loans, your entire financial reality,
all of it rests on trust. Trust that banks will honor withdrawals. Trust that governments will step in when things break. Trust that the system designed to create money out of nothing won't one day collapse back into nothing. Maybe that trust is justified. Maybe it's not. But now you know what you're trusting. And that's worth more than most people ever learn.